Have you ever wondered why wealth management strategies vary so drastically from one person to the next? Or why high net worth individuals receive different guidance and tools compared to retail investors? Today, we dive into the world of high net worth wealth management, uncovering the key differences and exclusive strategies that could be game changers for those looking to grow their wealth. Join us as we speak with Denis, portfolio manager at TVH Wealth, and get a behind-the-scenes look at how the wealthy manage, preserve, and multiply their assets. So stay tuned.
Wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day.
Well, we are live, and I'd like to thank everyone for joining the Money Mindset Mastery podcast. I'm your host, Jim Lao, and joining me today is my co-host, Ryan. Ryan, how are things today?
Things are going great. The weather, or not the weather, but the sun setting is really affecting my ability to stay awake at times. So I think we should do these afternoon at lunchtime, maybe for future.
Yeah, maybe, but before lunch, not right after. But no, I think we're going to be okay. And we have joining us as well is our co-host and portfolio manager at TVH Wealth, Denis. Denis, thanks for joining us. How are things today?
Things are going well, and thanks for inviting me.
Yeah, it's our pleasure. Well, the reason why we wanted to have you on this episode is we want to talk about the difference between retail investing and high net worth wealth management and investing. And I know that Ryan and I have been in meetings with clients, and he would point out to people who had mutual funds at the bank that, you know what, you're investing in retail right now. It's like going to Walmart or the Canadian Tire for your investments, essentially. And we should probably consider looking at something that's a little bit more specialized, better for you, which would be the high net worth platform. So, Denis, maybe we can start off with what is the difference between retail investing and high net worth wealth management?
Well, if you're looking at retail investing, it's really just putting money in an RSP or maybe even a TFSA. There's no real thought to it. Sometimes you're chasing returns. You're just investing. There's no strategy. Sometimes you get a strategy from some of the new discount brokers, but it's static. You're not making changes. You're in the same asset classes all the time. And when it comes to high net worth, first of all, even when you get into high net worth, the definition itself is about $1 million in investable assets. Some firms still have it at 500,000, but that's now moved up to $1 million for most firms. And you're really looking at more of a strategy to your assets. You're adding goals to the account. You're thinking about taxes. You're thinking about potential asset protection, probate, all kinds of different strategies for the high net worth. It's no longer going after the highest return possible and switching back and forth to chase that. It's a strategy, and it's a long-term strategy.
And through Raintree Wealth Management and TVH Wealth, we do have portfolios that are structured more or geared towards high net worth investors. Is that correct when you look at all the sub-managers within the portfolio?
Yeah, there's also the sub-managers, there's alternative assets in there, there's active management. So it's possible that we could be out of an asset class altogether, depending on what the situation is. If we see long-term returns negative, we're not going to be in there, or we're going to move it around from long-term. If you're in the fixed income, we may move from long-term bonds to short-term bonds, depending on the interest rate environment. It's active. We also look at the correlation between the assets we're buying, which means if the market goes up in Toronto 10%, and the U.S. is about 11, 12%, and Europe's about 8, 9%. Well, are you really diversifying, reducing risk? No. You got to find something that may move a little differently than the rest of the assets within the portfolio. That's that's what you get when you start investing in portfolio management, and also, and that's what the high net worth I've been doing for a while now. A lot of firms are moving towards adding a little more alternatives as well. I just went to a major bank presentation, and in their portfolios, they started just this summer adding some alternatives. They realized that it's not diversification between countries or regions sometimes is not really giving you the diversification you want. So you have to move to different asset classes, and at the same time, alternatives. And of course, we know alternatives can be illiquid. Some of it's only priced once a month. It's not for everybody. And if you're going to buy it on your own and you're going to get into some of this illiquid stuff, depending on what type of product it is, you may be hitting the exempt market area. Again, an area for mostly high net worth because of the criteria that's required before you're able to buy these. Million investable assets, high salaries, that 200-300 range. But within a portfolio, that criteria goes away. For instance, our portfolios are still priced every day despite holding some of these illiquid assets. So again, portfolio is probably the better way. If you're going to do it on your own, it's still possible. To buy your own alternatives, private debt, private equity, but it's a little more difficult.
So, in terms of the high net worth portfolio management solution that we currently offer through TVH Wealth, what is the entry point for a new investor if they want to have access to the high net worth platform and they don't have $1 million to invest?
No, it depends. We go into family assets. So if you bring your parents have accounts, you have accounts, maybe your brother has an account. We're looking at that family assets of about 250. On a referral, that may come down to 100, depending on the type of client and what they're looking for. We got to make sure that this is the appropriate investment for them as well. So that's what we're looking at. We're not looking at the $1 million minimums. I know a lot of firms have minimums of 500,000, some going up to $1 million. We're trying to keep it low for now to make sure everybody has a chance to get in, and it's working out. It's working out well for us. So it's a mixture. Even some of the family members. One family member may have $1 million. The other ones only have 100,000. That works well in putting it all together when you're looking at the family assets to achieve these minimums.
Well, then let me ask you this question. So let's assume we have someone who has $250,000 to invest. Why should they take that money to you under the high net worth platform compared to putting the money into a robo-advisor, mutual funds at the bank? Like, why should they be coming to you and handing you those funds? What do you have to offer under this high net worth platform?
Well, really, it depends what they are looking for. If they're looking at the highest return and they want their exposure to NVIDIA and Bitcoin, then that's not going to be for us. What we're looking for is somebody who wants to have a strategy, who's not looking for potentially big losses. So we have some risk management strategies, and that's the way we diversify the portfolio. We also have, depending again on the type of account, as a portfolio manager, all fees are charged outside. They could use anything on a non-registered account can be used as a tax write-off, the management fee. Mutual funds, obviously, you don't give that because the fee's encompassing unless you're in the F class. So again, if they're not looking for the aggressive portfolio, then the portfolio management solution is probably for them. It gives you more steady returns, and you see that a lot. It's managed similar to a pension. So what I'm talking about, this is what the pensions I've been doing for the last 10, 20 years. If you want that type of investment where you're not going to make some heavy bets, but look for that steady return with some protection on the downside, that's when you come to. All
right, Ryan, do you have anything for Denis? You're kind of sitting there.
Yeah, taking it all in
attentively.
Well, yeah, because as somebody who held my mutual fund license too, I spent a lot of time looking at different mutual funds, and I think I would challenge a lot of people to go back to what they're often holding, and hold up the fact sheets of what each of the holdings are, And what you will find, I'm going to say 95% of the time, you're going to find they all are showing the exact same funds in all of their holdings. It'll give you the top 20 list of what are the top 20 holdings out of probably potentially 100 holdings in that one particular mutual fund. I would challenge people to go back and look to see and compare and take a highlighter to see how often they cross over. So what I'm saying is that there's no difference between, it's a tweaking of how much of each of them. So it's really not diversifying your portfolio, which is what a lot of institutions claim. And this is what I've learned from moving from different institutions and learning from what I've learned over my time as an advisor too, is there's very little difference. And working with Denis, working with Raintree, I've noticed they're looking at different areas, they're looking at different opportunities. And then the second part to that, which is the story that we've kind of said all along, which is if you love your heart racing, and when the market's really down, you're stressed, you're not sleeping at night. That's what you're going to get in other places. But if the TVH, tortoise versus hare, the slow and steady wins the race of not always chasing a return. There is return, that's part of the strategy, but that you're also diversifying outside of simple mutual funds, whatever the TFA holdings are, then I want you to seriously come to Denis and have a real look at what you're currently holding and how you're really exposing yourself, especially as we saw the market go down, 3 or 4 years ago, especially, and people are still feeling the hurt from how the market came down. Kind of the proof is in the pudding as far as what the market is to be able to level out some of that hurt and not, I've been in the meetings with you too, and when there's a hurt on the market itself, Raintree's doing a better job. You're doing a better job of mitigating some of those downward turns in the market, which makes people sleep better at night. And I feel like the clients that I talk to that are now no longer seeing these large changes in the market are really able to we have a strategy in place. And the strategy is a mix of working with TVH Financial and TVH Wealth and some of the other partners within the TVH group that allow a better sleep at night for that matter. And also as Jim, you and I talk about a lot of your clients that are approaching those retirement years or are in retirement, and the market has taken a downward turn. And those people are like, I'm really glad that we stuck with the strategy, because the same people that are in my shoes that are in those retirement years are really struggling. And that we've talked about it before, how different strategies and that we're not putting all our eggs in one basket can really help somebody over time, instead of chasing a very large return, which makes your heart beat way too fast sometimes. So, yeah.
Yeah,
Well, I
you
think I
make
want
a
to talk
good
about
point when
kind
it
of
comes to
what we've recreated.
risk level. On a high net worth side, you tend to look at all the accounts differently. They will not have the same risk level. And what we're trying to do is you assign a goal to all the accounts. And the one thing about the high net worth, you tend to see more non-registered assets as well. Non-registered assets is obviously if you're either you maximize your RSP or it's big enough, you don't need to add more. It could because you see your retirement as you don't want to just redeem money that's going to be fully taxable. So your RSP and your non-registered may have a different risk level as well as your TFSA. And you also may hold funds in a corporation that, again, may have a different risk level. So it really depends on the strategies, your tax strategies, even your estate, because as the more funds you have, the more funds you're likely going to be left with. Not always the case, but we'll just say for the most part it is. So you really want to do some estate planning as well as a high net worth investor. How much you're going to leave the kids, the grandkids, Is it a business? Are you going to leave it within a trust? Depending on, and this is mostly a testamentary trust where the trust is set up within the will. So after you pass away, then the trust is set up to distribute your assets. There's a lot of planning and strategies that take place for high net worth investors. And I mentioned trust for high net worth. Trust doesn't have to be for high net worth, depending on what your goals are. So you want to look at the different strategies, risk management, tax planning, estate planning, and investment diversification for everything when it comes to anybody's basically investment strategy. It's part of the plan. So that I see as a big difference. When I was younger, investing in my discount brokerage at the time, it was just a matter of stock picking. Stock picking, get the highest return. Some of them made it, some of them didn't. We had a great small cap oil analyst. He gave me some great tips. It was a matter of these hit and misses. But as I got older, it became more of a strategy and what to do and how to invest, as opposed to chasing the highest return that may not be the highest return next year because it was this year. And that's the key.
Well, I think what I want to do is paint the picture and really drive home why people should be working with us at TVH Group. So traditionally, Denis, like you mentioned in the beginning, a high net worth investor was someone who had $1 million plus to invest. So if you had the $1 million plus, now at the bank, once upon a time, if you had $500,000, like you said, you would be considered a high net worth investor, and you'd have a lot of the additional bells and whistles and services like the estate planning piece and tax planning and whatever else. And I'd say over the last decade, a lot of the banks now, what they've done to those clients who were receiving those services and had the 500,000, between the 500 to $1 million, they're all of a sudden being asked to leave or being pushed back at the branch level. And, they were accustomed to receiving the tax planning and the estate planning, specialized service. And then all of a sudden they went back to, well, now you're back to being a retail investor. And they were treated like a retail investor. And just to kind of explain again, if you're a retail investor and you don't have traditionally that $1 million, you go to the bank, they're going to put you in a stock and bond portfolio. It's going to most likely be anywhere from an 80-20 to a 60-40. And you're investing like everybody else, nothing special, no tax planning, nothing beyond, just here's the investment. Let's go through your risk profile. Here's how you're going to be invested. Here's what your fee is. And then no one's really looking at your portfolio. No one's really looking at your account. It's there doing whatever. And a lot of times it's left up to you to kind of figure out, should you make any changes? Should you stick with the investment? There's no assistance unless you make the phone call. What we've done at TVH Group in building the team that we've built is you no longer need that $1 million. So at $250,000, like you said, Denis, someone has $250,000, they have access to your services on the private or portfolio wealth management component. However, we also offer the tax planning. We also offer the estate planning. We offer the full service financial planning piece that people are also looking for. So to work with TVH Group, you don't need to have that $1 million plus. The regular retail investor that would be treated like a retail investor at the bank would be treated just like a high net worth investor within the group based on the structure that we have in place. And in addition to, again, our services with the wealth management side, tax planning, the estate planning, the retirement planning, we also have the legal planning as well. So we have legal assistance. We also have the mortgage financing. So the bottom line is, if you're currently stuck as a retail investor and you're receiving limited services for the mutual fund fee that you're paying, which is most likely going to be closer to 2.5%. And by the way, there's no tax benefit if it's a non-registered account. You should take a look at us because our fees are lower. Plus we have these additional solutions that we'd be able to assist you with. Anything to add to my little rant there?
No, I think you have a point. Like, we do have $1 million clients, but we also have the clients with less asset, and they get treated, for whatever they're looking for. We have the solutions for it. So a lot of it is when you create a relationship with somebody, And that's not necessarily they have up 250 now and they won't make a million. So it's a matter of creating that relationship, giving them some good ideas how to increase that, regular contributions, and then opening it up. If somebody's younger, they may not want to talk too much about their estate. They'll get a picture of it on the plan, what it would look like. But as they get older, the thought changes. And then working with us, because we know them, we could discuss what it is. We know you have a son. We know we have a daughter. This is what their, the career path. We know that. We know, how they want to split their assets in the end and the strategies to do so. That may include, in some case, insurance, permanent policies, rather some of them, bigger than normal, as part of the estate strategy as well, and part of their giving. And speaking of giving, some the high net worth will tend to leave or they can leave maybe a little extra for charities that they've always been to. A religious institution, they may have been affected by cancer. They want to leave a little money to the cancer. This is part of the planning, and it's also part of the tax planning, not only investment planning and everything else to get there, but also part of the tax planning. So what your estate looks like. We have a picture if you were to pass away in a week, what it would look like, how much taxes you would pay, probate fees, everything. In some cases that, because probate, especially during post-COVID, tends to be a little longer, some of these estates may need liquidity sooner rather than later. So maybe a little bit goes into investing into seg funds that bypasses the estate. And also you don't pay probate fees on it, but it also bypasses and you get it much quicker. So these are, potential strategies that we speak to clients about. And again, you don't need to have the $1 million or $2 million. This may be a strategy for somebody's at $200,000-300,000, depending on what they're looking for. So that's why doing the full package, I think is good. And I think the processes Jim, you and Ryan have set up treats clients well and really looks after them.
Yeah, no, I agree. And I think I also want to maybe discuss the difference between an account manager and a portfolio manager like yourself. An account manager at the bank, and again, I speak as a former banker. Denis, you're a former banker as well, so this isn't something we're making up ourselves. But an account manager is someone who is given a bunch of accounts, and their job is to take care of those individuals within the account itself. And then the account manager tends to move on. They're an employee of the bank. They're looking at growing their own career. Account managers typically don't stay as account managers for their entire career. So you've built a bit of a relationship, a rapport with the person. You really like them. And then they're gone. And now guess what? You're assigned a new account manager. And you go through the same process again for 6 to 8, 12 months. And then you're assigned a new account manager. And it's constantly repeating. Can you imagine if every 6 to 12 months you change your family doctor or your family doctor was changed on you, right? Like you've built that relationship, the rapport. The family doctor has seen your family grow, like changes in your family. You've built a long-term relationship. Can you imagine changing every 6 to 8 months? That's frustrating. When you're dealing with a portfolio manager like Denis, or you're dealing with wealth advisors like Ryan and myself, we're not account managers. We are in the business. We own the businesses that we represent, meaning TVH Financial. We have referral arrangements with the other team members that we talked about, including TVH Wealth. I've worked with clients for 25, 30 years. They're still clients of mine now. It's amazing how when we first met, retirement seems so far away. And now they've been in retirement for a few years. They've worked through the plan with me, and now I'm talking to their kids, right? And now they're selling their homes, downsizing. It's been a 25, 30-year relationship. You get to know people at a different level when you have that relationship. So that is really the biggest difference. And you don't need $1 million for that. As I mentioned, you come in with your $250,000. You'll get that full service. We'll work with you if you have less than that. It just means you might not have access to the private portfolio management piece, but we do have other solutions. I think that's the other benefit too, right? Because we're independent, we don't have the same restrictions as you would have if you were working at the bank with a banker. They can only offer you what the bank is putting on their shelf to offer, right? So when you're dealing with someone at the bank, and I know this quite well, they're going to put a portfolio together based on the funds that they have access to. They might not necessarily be the best funds on the marketplace, and I've seen that as well throughout the year. So again, I just want to really point out and highlight the importance of working with a team that's going to help you from a holistic point of view, not just focus on your investment, not just focus on your debt. We go from start to finish. We'll start off with cash flow planning as a starting point for people who are starting off and struggling with cash flow, all the way to the estate planning piece. We can help you from start to finish. So I think that's my piece. Ryan, go ahead.
Well, I was just going to add the other part is our ability to be a lot more flexible as to when and how we can meet our clients. I found that always very frustrating as a worker, and I'd have to take time off work just to go to the bank to clear up some things. Where our ability with online and just like we're doing virtual, our ability to meet outside of what those needs and meet the needs of the clients and their busy schedules, especially with families and businesses being run, at least from what I see with working with your clients, Jim, and my own, is that flexibility is worth a lot to a family that has 3 kids at home, and they're able to put their kids to bed and be able to have a chat with us, right? So,
well, I know the banks have started the virtual meetings, built into your banking app, and at any time, anywhere, you can call in and speak to a financial professional. But that's the thing, is you're not dealing with the same person repeatedly, right? So depending on what time you call and you reach out and you're doing the virtual face-to-face, you're not dealing with your individual that you've worked throughout the years. Where with us, it is us, right? You're contacting your person who knows your history, knows your tendencies, knows what your goals are. It's not based on a window pop-up that is provided to them based on some algorithm or historical conversations you've had with 2 or 3 other people. It's at a personal level, and we're providing you that at the personal level. So
Yeah, and just to add to that, going back to a little bit your original question, it's not just banks either. It's difficult sometimes to find a good advisor that's going to give the full service, that's going to be fully capable of giving the good service and is knowledgeable, even on the products they're selling. Is it something that they're getting paid more on? Is it something that they always sell it, so they're going to continue selling it despite in the background maybe the managers and the performance is just not like it used to be? It opens it up. As portfolio manager, obviously, I'm part of the team that makes the selections on the investment, so I could easily talk about it with my clients on how we're investing, what's doing well, what's not doing well, and clearly the risk level could speak to that. So it's a matter in the end when you're selecting an advisor, and that's why if you're with somebody, and I come from a firm, a financial planning firm that had huge amount of turnover, especially on the young kids side. They were just, it was like every 6 months you get a pile of new people coming in, and then they would leave, and then you get new ones again after that. So it's really building trust with the client. They have to know you're making decisions for them and only them, not because this is a higher commission or I'm not licensed for that other products, I have to sell you this. It's making decisions for the client in all cases and for what they're looking for. That's why when you know a client more, the trust level's there, that's when you get the complete plan. As you know, if you're creating a plan and it's not as accurate or you don't know enough information, it's garbage in, garbage out. The plan's going to be worthless. But if you know the client, you're dealing with them, you know if it looks right, if you could discuss it and we continue updating it, that's when you know, okay, you're on the right track. You're not, it's the same person. It's a team we're working on. We back each other up. So if there's something going on, we all know the clients as well. So that's the on the portfolio manager, when you're knowing the decisions of the investments, you're knowing the client and trusting them. It's just a full package. And with you guys as well, the same thing. You know the client, you went through with all the details, you created that plan, you got all the information out. This is where it's a positive impact, and it's best for the client.
Well, I think just to kind of keep pushing on that point too, we work as a team on behalf of a client. So you're not necessarily, when you work with any one of us, you're not just working with a single advisor, you're working with a team of advisors. So there are times where Ryan and I have worked on plans together and we're kind of sharing our input and our thought process. Sometimes we bring in John if there's a real estate component to it and get his opinion. And there are times where he comes out with a different angle that I never really thought of or Ryan didn't think of. We've done that with him as well in situations with clients that he's working with. Denis, obviously with you. So I think that's the other benefit too, is when you hire TVH and an advisor at TVH, you're not only working with a single advisor hoping that they're going to make all the right decisions. You are working with a team, with a family of professionals who we can tap into each person's, again, experience, their knowledge, their expertise, their education, to ultimately try to present the best solution available. Now, things change, obviously. Things unexpectedly do happen, but you're working with a group of professionals as opposed to just one single individual who's going to put you in a 60-40 mutual fund portfolio. Or I love it when I have clients come to me saying, well, my banker suggested should put all my money in Disney, for example, or put it all into this other stock. And I just think to myself, like, do they actually listen to what your goals are? Do they actually listen to when you need this money, why you need it for them to make that type of recommendation? They're clearly not listening to you. They're going ahead and they're basically Vegas gambling with your money is what they're doing in that situation. And I've heard it too many times from people where that would have been the recommendation from their advisor from one of the big banks. That's just terrible, right? So I think, guys, I think we could probably start winding this down. And I think it was a good conversation. I know we've had these conversations before. We've talked about the difference. I think people really need to experience it. So if you do have the 250,000 and you're looking for a separate or a second opinion, reach out to us. We'd be more than happy to do an assessment for you, no cost, and provide you with some feedback. And if there's any gaps we've identified, if we think there's some better opportunities, a different way of doing things, it's the old, you don't know what you don't know. And it's amazing how many times people come to us thinking that they know everything about investing and planning and whatever else. And they walk through the process with us and will finally admit that they thought they knew a lot, but they only really knew a small fraction of what they really needed to know to make the proper decisions for themselves, financially speaking. So it doesn't hurt just to reach out. So, Denis, how can people reach out to you if they have any questions or would like an assessment on their portfolio?
Any question, a quick email would be fine. It's just Denis, my name's at the bottom there of my head, at tvhwealth.ca. And any conversation, if they want to chat about anything, just because you're calling doesn't mean you have to become a client. It's just a conversation to start.
For sure. And Ryan, they can reach us at 647-727-4668. TVH Group is a good landing place because if you actually go to tvhgroup.ca, you'll see all the departments and all the services that we offer with all the referring partners. So that'd be a good start. But if you want to go direct to TVH Financial, you can find us at tvhfinancial.ca. And obviously, all the social media accounts. We do a weekly blog post, which is part of the podcast that we do as well. So we've just rebranded our podcast to our blog post to the Money Mindset Mastery blog. So look out for that. That's also on all of our websites. It's on TVH Wealth's website, on TVH Financials and TVH Groups. But yeah, we're out there. We're going to continue on putting content together. I think next week, Ryan, we might be talking about something mortgage related.
That's correct. Yes.
Yeah. Do we know what yet?
We're
Do you want to share a little bit of what we're going to be talking about?
Well, yeah, we're talking a little about mortgages and the difference of working with a mortgage and a bank advisor when it comes to mortgages, and the importance of knowing the information and even the steps that you need to take. It's especially for people that are looking to buy a home, a second home, investment property, things like that. What are the steps you need to take to make sure there's easy flow and less stress on the whole start to finish? Because people often get the steps mixed up, and we want to clarify and make sure it's smooth for everybody. So, yeah.
And we're going to have special guest Josh Brooks, mortgage agent at TVH Mortgages, correct?
That's correct, yes.
Awesome. Well, I'm looking forward to that episode. Everyone, have a wonderful evening. Until the next time, another one is in the books. Take care.
Good night.
Why is it me? Why am I a guy? I still